Welcome to Property Focus, I'm James Mitchell. Making headlines this week, one industry figure warns of the risks of self-managed super funds, and Sydney property is slow to sell at the high end. But first, to our lead story. The Australian housing market remains soft, with values dipping across all capital cities according to the latest RP Data Rismark Home Value Index. Home values in capital cities fell 4% in the 10 months to October. Meanwhile, the dollar value of rents has been rising at a 4 to 5% pace over the course of the year. RP Data's senior research analyst Cameron Kusher told Property Focus that these figures should entice investors looking for a positively geared property.
If you're looking to negative gear a property and banking on future capital growth, there's probably not going to be much capital growth over the next few years. But if you're looking for a positively geared investment, there's going to be more and more opportunities, particularly if the Reserve Bank cuts interest rates and we get those passed on from the banks.
Australians are opting to purchase property using a self-managed super fund, which allows them to borrow up to 70% of the asset's value. However, investors should be aware that self-managed super funds are costly and involve a great deal of responsibility, according to Property Investment Professionals of Australia Chair and Destiny Financial Solutions founder Margaret Loams. Speaking to Property Focus, Ms. Lomas said that she has deep concerns over people using self-managed super funds to borrow to buy property.
If that property is vacant, then there's no income. If that property doesn't grow in value, then the entire investment strategy is at risk. The other problem with self-managed super funds is that very few people realise the compliance required when you have a self-managed super fund, and you can very easily do the wrong thing, which means the tax office declares your super fund non-compliant and you will lose 45% of its assets to tax.
When considering your next investment, it is important to remember that real estate has many markets, performing at different speeds according to Real Estate Institute of New South Wales Deputy Chairman David Gray. Mr Gray said that in Sydney, properties around the 500k mark are selling strongly, while those towards the upper end are lagging.
We're seeing a different segment in the market. That 4 to 500 market at the moment is going like crazy. But then if you look at some of the houses in the North Shore at the moment are really slow, and Rose Bay, Double Bay, 2 million plus is slow. So we've got to look at the different segment where your property sits.
And don't forget that the December issue of Smart Property Investment is now on newsstands. Grab a copy today to find out where you can save thousands by investing this Christmas. This issue is a must for all investors looking to bag a bargain this side of the new year. That's what's making headlines this week. I'm James Mitchell. See you soon.